Hello everyone, this is Amit from Ecovisionnaire. I hope you have watched my 3 previous videos on national income. Today I'll explain you the 3 most important concepts used in conversion of national income aggregates. कैसे GDP को NNP FC में, NDP FC को GNP MP में, how do you convert by using 3 basic rules where you use the concepts NFIA, that is net factor income from abroad, depreciation and net indirect taxes. So let us understand net factor income from abroad first. First, we'll understand the meaning of these 3 concepts and then we will try to do some conversion. So net factor income from abroad. This is the income which Indian residents earn from abroad and it's net. It's not factor income from abroad. It is net factor income from abroad. So when we say net factor income from abroad, we are saying it is factor income from abroad minus factor income to abroad. Example, Indian residents earned $70 billion from abroad and foreign residents and companies have earned $50 billion from India. So what is net factor income earned by India from abroad? It is $20 billion. So that is not a remittance, it is earned income from abroad. उसमें 3 चीजें आती हैं. What are the components of net factor income from abroad? 1, net compensation of employees. If someone is an Indian resident and he earns from abroad, it is a salary earned from abroad, which is less than 1 year if they have stayed. It is compensation of employees and salary paid to employee. अगर net word लिखा है तो FIFA minus FITA हो चुका है. अगर net word लिखा है तो. Then net income from property and entrepreneurship. We earn rent from our property abroad, and also our resident companies like Reliance, Tata, maybe Haldiram, they are having their branches abroad. So net retained earnings which we received from abroad, and then again foreign companies take their money abroad. So उनका जो difference है, that is net retained earnings. So retained earnings, income from property and salaries, they are earned by Indian residents abroad and they are earned by foreign residents in India. उन दोनों का जो difference होगा वो NFIA होगा. So where is NFIA used? Very easy. NFIA is used very easy to calculate national. So national निकालने के लिए we have to add NFIA to domestic. So domestic plus NFIA gives me national and national minus NFIA gives me domestic. So first rule. Coming to second adjustment, that is depreciation, also called consumption of fixed capital. एक machine, एक fixed asset जो होता है कितनी बार वो depreciate होता है. Throughout the year it is depreciated. So taking its gross value will not give justice to the national income. So we subtract the depreciation. And why is depreciation caused? Very easy. The machine is in use, so it's wear and tear. When we continuously use the machine, it leads to fall in its value. The passage of time and then it becomes old, expected obsolescence. So when new technology comes, the old one becomes less usable, so that the level goes, the market value or the machine depreciates. So we subtract depreciation to get the net figure, because national income is a net figure. And student, I'm telling you, national income is nothing but NNPFC. So whenever it is NNPFC, it is talking about national income. So in the previous slide, we have converted this domestic into national by adding NFIA. This slide, we are talking about net, the first N. So how to get net? Very easy. Gross में से अगर हम depreciation minus कर दें तो net figure आती है. And if the question asks gross figure, then please add depreciation or consumption of fixed capital to net. So gross to net minus depreciation, net to gross plus depreciation. So that is how we change gross and net investment, because national income is a net figure. So we have to subtract the depreciation. Other name is consumption of fixed capital, replacement cost. ये सब अलग-अलग नाम दिए होते हैं. Third adjustment is very easy, that is NIT. This is the conversion done to convert market price to factor cost. Market price also includes taxes. So therefore, we don't need taxes in the national income. So we need to subtract NIT from MP to get FC. So why it is NIT? Why not IT? Because NIT is IT minus subsidies. If government takes a transfer called IT from us, government also gives us back a transfer called subsidy. So if government has taken 300 crores from us as indirect taxes, that is GST, and government has given us back 250 crores of the subsidies. So therefore, what is the free amount given to the government by the public? That is 50 crore. So the free transaction, free interaction is only 50 crores. So we subtract 50 crores from the market price to get factor cost. Again, I'm telling you why factor cost, because national income is NNPFC. So we have got gross to net, we have got domestic to national, and we have got MP to FC. So I'll just revise a bit with you. To get national, I add NFIA to domestic. To get net, I subtract depreciation from gross. To get factor cost, I subtract NIT from market price. So these are the three adjustments we have to do. If you want to learn it and understand it in a better way, then I'll tell you one trick. Take gross, market price and national. Assume them, because national can be smaller also, as big figures. So gross, MP and national as big figures, and net, factor cost and domestic as small figures. And you should learn their adjustments. Gross and net has depreciation in between. Market and factor cost have NIT in between. National and domestic have NFIA in between. So when we go from big to small, we always subtract. And when we go from small to big, we always add. So gross to net minus depreciation, MP to FC minus NIT, national to domestic minus NFIA. Reverse करते हैं. Net to gross plus depreciation, factor cost to market price plus NIT, and domestic to national is plus NFIA. So we'll do some questions and then understand how to convert. So here we need to convert GDP MP to NNPFC. So student, be careful. The first words are gross and net. So gross is big, net is small. Gross to net, I have done minus depreciation. Converted. Then domestic has to be converted into national. So domestic is small and national is big. So I have added NFIA. MP is big, FC is small. So I have subtracted NIT. I hope you understood. Coming to question number 2. We have to get gross national product at market price, and we have been given net domestic product at factor cost. As I told you before, net, domestic and factor cost, all the three are assumed to be small. And gross, national and MP, these three items are supposed to be big. So going from small to big, you have to add the adjustment. So what is the adjustment from net and gross? Plus depreciation, domestic national plus NFIA, and FCMP plus NIT. Similarly, coming to the third question, we have to move from gross to net, that is big to small. We will minus depreciation. National is big, domestic is small, we will minus NFIA, but FC is small, MP is big, we will plus NIT. Coming to the second last part, net to gross, small to big plus depreciation, national to domestic, big to small minus NFIA, and small to big again plus NIT. The last one is again very easy. Net to gross, small to big plus depreciation, big to small, national to domestic minus NFIA, and again big to small, MP to FC is NIT. I hope you understood the conversion, because in numerical question they ask you the conversions also, because in national income through income method we first get NDPFC and the question asks GNPMP, and in the expenditure method we get GDPMP by adding 4 items, and then we are asked to get NDPMP or any other aggregate. Coming to the last numerical question, which you can understand using these formulas, the first thing which we have to see is what is given to us. Domestic income NDPFC is given, NFIA, depreciation, and NIT. All the 3 conversions are given to us. So asked NNPFC. So to get NNPFC, we have to add domestic में हमें NFIA add करना है to get NNPFC. So 10,000 plus 200 gives me 10,200. That is NNPFC. Then they are asking for GDPFC. Again, a very easy part. We already have NDPFC. Only net to gross has to be done. So that is plus depreciation. So 10,000 plus depreciation is 10,300. Third one is GDPMP. We have already calculated GDPFC. The only conversion is FC into MP, that is plus NIT, small to big. So what is GDPMP? 10,300. GDPFC 10,300. What is NIT? 250. So that comes to 10,550. That is GDPMP. Then coming to NDPMP. We already have GDPMP. So just gross to net minus depreciation. So what is NDPMP? What is GDPMP? 10,550. What is NDPMP minus depreciation? That is 300. So 10,250 is the NDPMP. Then they ask what is GNPFC. Again, a very easy part. GNPFC. We already had GDPFC. It is here. GDPFC is 10,300 and D2N, domestic to national, is plus NFIA. So 10,300 plus NFIA 200 gives me 10,500. So GNPFC is 10,500 and the last is GNPMP. Very easy. GNPMP nikalna hai and we have GNPFC with us. Only FC to MP, that is plus NIT. So what is 10,500 plus NIT, that is 250. That comes to 10,750. This is how you convert net to gross, domestic to national, and market price to factor cost. To have more worksheets like this, you can go to our Ecovisionnaire app and practice these tests and worksheets from there. And also, if you want some economics coaching, you can contact me on 9891203546. I'll be back with video number 5, which will be based on national income using income method. Thank you. Take care.